Sarat, it's great to see you this morning. It's been quite a week. We've been discussing whether the Fed is almost too much in focus, and that's what we've been focusing on. Is that a problem at this point, or do you think that's what we're supposed to be doing?
Well, I think the Fed's been pretty quiet for the last couple of years, and I think now they're front and center. Credibility is the main concern here for the Fed. And I think, investors are really focused. We haven't seen this, Andrew, in many years. So right now, earnings have taken a backseat. And I really think earnings season is going to be very important for a lot of companies. And really to kind of say, hey, look, we've come out of this pandemic into an endemic. Let's just see what earnings power is going to look like.
Let's talk about some of your picks, though, because you like Morgan Stanley, you like Disney, you like GE. Why?
So very different stories there. Let's just break up Morgan Stanley. Morgan Stanley is now down 15% for the year. 60% of their business is recurring revenue asset management. They don't really have a lot of credit risk out there. They're not this global company like some of their other banks, but right now they've been thrown into this financials ETF. And, I think the management team there is going to show you that the balance sheet's very strong. They've got a dividend over 3%. So I think, the multiple compression there, I feel is not necessary at this point. Take Disney. We're coming out, again, as I just mentioned, the demand for Disney. I mean, you look at 40% ticket increases pre-2019. So you've got the consumer coming out there. I call it, quote, the revenge economy. And Disney's kind of been put in the penalty box because, quote, now there's these recessionary fears. But it's different because the consumer now just wants to leave their home. They want to do other things.
But isn't the question, Sarat, not about what people want to do today, but about what people may or may not want to do 12 months from now? If you believe the stock market is lower, if you believe the wealth effect isn't there and people are a little bit more skittish and nervous, and they say to themselves, we were planning on taking that trip, but maybe we shouldn't.
I don't disagree with you, but I also think what happens in times like this is people sell their stocks quickly and then kind of say, let's see how it's going to go. Our view is things will slow down, but not to the point that it's going to be as bad as what some of these stocks are reflecting, because they're also coming out of really low comps. I mean, if you look at kind of where Disney was last year, you look at the earnings power of their businesses, including Disney Plus, which is still growing. I think, it's a valuation-centric what we're looking at here, Andrew. These are stocks that are trading below market multiples. I'm not talking about pie in the sky, trading at 15 times sales. These are companies that are strong cash flow. I mean, Disney even stopped their dividend just to kind of preserve cash, and now they're in growth mode. So Morgan Stanley's and Disney's the world. I call them kind of like the blue chips. There's some, I think there's a lot more potential there, but the market's saying, hey, really strong recession fears, stay away from these stocks.